All right, we are at a quorum. So guys, we're gonna move item number one up on to number one again, which is to hear and consider and approve the minutes of the regular meeting of April 27th, 2022. I have within the minute, I have a comment that I'd like to bring forward. Two things, two edits, Cheryl, that I'd want to make at the very end of item number 3. There's a sentence that says it was mentioned to the board that principal's fees are flat rated dash 1.1%. I'm not sure what that is. I don't know what a flat rated is. And I'm wondering if we can get clarification on that. I wonder if it should instead read, fees are 1.1%. And then the second item that I have is under point 6, old business, at the very end, the last bullet point. There's a sentence, a line that begins deposited into one account, and at the end of the year will review. I think that comment was from the CFO, that the settlement funds are deposited into one account, and then at the end of the year they get apportioned out into the funds, right, into the separate funds. And so I think that should be made more clear, that they will then be apportioned to the funds.
Okay.
Okay.
Mm-hmm.
Anyone else have any comments on the minutes? No. If somebody would, I'll make happy to make the motion on that, since I have the edits. That I would make a motion that we approve the minutes with the two corrections pointed out. Someone like to say?
Second that, Karen, it's Jack.
Thanks, Jack. Okay, a second. All in favor, say aye. Raise your hand.
Aye.
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 Imagine
Anyone?
that I've raised my, because it's true.
Okay. Any abstained?
Eric Calp, I'm going to abstain.
Okay. Any opposed? Okay. Perfect. All right, guys, thank you very much. Let's go forward. Brian Binkley, you were kind enough to reach out to Lexington on our behalf. Mark, Andrew, welcome. Welcome to the board. I think you might still be muted.
Yeah, I want to make sure my speaker works. Because I couldn't hear you guys. Let me try it differently.
We hear you. There's a little echo.
Carol, could I interrupt with a housekeeping matter, please?
Please.
This is Tom. Do we have presentations we should be reviewing, or is this just a spoken presentation?
There is a presentation that was sent. Cheryl Lynch sent it under the email from Chris Buccamazzo, in your inbox. And I will, when I hit mute here, I'll send it around to you so you have it again. And I'm sure that we can bring that up on the screen.
Yeah, I don't think I got it in my current email. It might be in my old email, but I didn't see it. But I could. It's an old email that I don't use. I don't use for this purpose. But we can talk about that separately. I'll talk to Cheryl about that separately.
You got it. All right. Let me see if I can get this into your hands.
Thank you.
So without further ado, Mark, are you able to share your screen? I think you might be muted again.
I could hear you before, but not now.
Yeah, for some reason I couldn't hear you guys without dialing in, so that's why I had to dial in with my phone. That's why you heard an echo before. So, so let me. I'll try to share my screen, I guess. How's that?
It's come up, Mark. Thank you.
Yeah. So look, there's really just a few slides I was going to talk to. And I think this is probably the one everyone cares about the most. This just kind of shows you the three investments that the town of Fairfield has made to our middle market secondary funds going back to 2009. So I'm going to start just in aggregate and the total. So in total, town of Fairfield has committed $18 million to Lexington. You've contributed out of that about $15.5 million. And then you've gotten back already $18.4 million. So you're net positive right now of $2.9 million, or about just under 120% of your contributed capital. You continue to have significant remaining value. It was shown in that partners capital line of 9.4 million. So for total value, including the distribution, is about $27.2 million, which results in a 1.8 times multiple on your money and just under 18% IRR from a performance standpoint. So I would say, I think this performance has been, really good. It's been really consistent. If I go fund by fund, LMMI2 is mature, not a lot of upside remaining in that, but you did make 1.9 times your money on it. And again, only about $1.3 million of remaining value in that fund. But again, it's an older fund, not tremendous upside, but also not a lot of significant downside because you've already gotten about 170% of your capital back there. And then LMMI3, that's where you have your largest exposure right now, about 5.6 million of remaining value. And I would say there continues to be some upside. And if I had to project, I would say that 1.8 times multiple will improve to that same 1.9 times that you saw in LMMI2. And then LMMI4 is still really young, but it's already marked at 1.4 times. And again, based on the underlying holdings, I think your remaining value there, 2.4 million, has, I think, probably the most upside out of all of these funds. So our hope is that 1.4 times will also get up to that kind of 1.8 to 1.9 times in that fund. So anyway, I think we'll have seen really consistent performance. I will say just one little footnote. If you look at the IRR for each of those funds, LMI2 did not utilize any credit facility early on in the fund life. And we did do that in LMI3 and LMI4. So that does benefit the IRR. And so you see about an improvement in LMI3 of 300 basis points is really driven by that usage of the credit facility early on. It's a modest amount. It's about 20% of the fund size, but it does help generate better IRRs. And that was the first fund that we utilized leverage on it. And then LMI4, similarly, we are utilizing leverage. That's a high multiple, that high IRR right now, 37%. But over time, as we pay down that credit facility, I think you'll see that IRR go back to kind of that consistent high teens, low 20s type IRR for LMI4. So again, end of the day, really consistent performance. I think really good performance from both outright performance, but also our strategy is a highly diversified strategy. So from a risk-adjusted return standpoint, really strong returns. And then just quickly, I'm going to go to page 11. That will show you kind of, and I'm looking at the pie chart here, that just shows you where your remaining value is, kind of the underlying GPs that are kind of managing these assets. Those are some of the names. So for me, up in Boston, I'm really familiar with and have seen over the last couple of weeks, TA Associates, Summit Partners, Kelso at their annual meetings. They continue to be pretty optimistic on their funds that we're in, and we think that's where I think there's upside from some of those underlying holdings. And then in LMMI4, again, this is a younger strategy, and on page 17, this more shows you kind of where that concentration is of value. So again, for me here, I'm sitting up in Boston. Some of the firms that are best known to me include Berkshire Partners, The Jordan Company, I had dinner with them last night, really optimistic, even in this environment we're going through, really optimistic that their companies are performing very well during these tough times. And then also I look at Rourke Capitals, again, Summit Partners and Abry Partners. A lot of, we think, upside left in these underlying holdings. So again, I know it's a tough environment right now, but we continue to stay pretty positive on what we own and think there's upside to some of the numbers I've shown you in your performance standpoint. So with that, I would open it up to any questions you would have. Happy to answer any questions you might have.
Mark, were those numbers that you put out there that you provided to us, the IRR and so forth, were those net of fees?
Yes, those are all net. Those are net returns to you after all fees.
Okay, great. Thanks.
Can you help us understand kind of the questions you're asking of the funds you're invested with here, kind of in light of the market conditions and the volatility in the markets overall? What are you
Yeah.
looking for?
Yeah, I would say again for our holdings, number one, it's a highly diversified strategy. Number two, I think where we've seen a lot of the tremendous volatility has been more on the tech side. A lot of our portfolio is less tech related. And I'm just going by some of the operating performance numbers we've seen from some of the GPs managing their assets that feel pretty optimistic about it. But I would also say, I expect that our valuations as we get into as the March 31 numbers roll out, as the June 30 numbers roll out, as September 30 rolls out, I'm not expecting any significant increases in value, but I'm also not expecting any significant declines. I do think the other thing that will be impacted is if you have your cash flow statements, we're distributing capital to our LPs every quarter consistently from the day we have a final close in our fund. We're distributing capital. I think we'll continue to do that, but I think the volume of distributions will slow as the activity of these sponsors of selling companies in a more difficult environment is going to be tougher to get done. So I do think we'll see distributions slowing in our portfolio. But again, that upside I'm talking about is the sponsors are not going to sell in a really tough environment and take any kind of discount. They're going to hold on to these assets because they're performing well, and they'll wait for a better environment to sell. So I'm not sure I specifically answered your question, but
Yeah, and I guess as a follow-up on that, on the flip side, I mean, is there still buying happening, particularly with the younger funds, right, to be able to take advantage of any type of distressed valuation opportunities that come along?
yeah, for the funds that you're in, the LMI4 fund, let me see if I can get a slide here. So you see up top here, LMI4 is now 84% committed. And the reality is based off of recent deals, that 84% is north of 90% at this point. So you are absolutely right. There is a tremendous buying opportunity, but this particular fund, our LMI strategy, is almost fully committed. So it's not going to change the profile of the fund. We have a separate global strategy where we're in the middle of raising $15 billion today. I think there's going to be a tremendous buying opportunity. And our biggest challenge right now is figuring out where to spend our time, because we're very focused on our pace of deployment, and we've already deployed a lot of capital in that new fund over a relatively short period of time because of that buying opportunity you're talking about. So we have large state pension plans that are feeling over allocated to private equity. They will sell down their portfolios over time. Kind of in the near term, I think there's going to be opportunities for us to buy that, but we have a high hurdle right now on what we're buying. Any
Could
other
you just be,
questions?
yeah, the high hurdle you just mentioned, are you talking about a projected IRR type of hurdle? What kind of high hurdle do you mean?
Yeah, I would say high hurdle in terms of IRR and also multiples. So I would say in a normal environment, we're trying to make our LPs and we're solving for somewhere in the 1.6 to 1.7 times. Again, we've outperformed that number, what you've seen in our LMMI strategy here. But that's what, and we're probably looking for a 15% IRR. And I would say right now, given how much capital we deployed over the last 6 months, I think that hurdle now is closer to 1.75 to 1.8, and the IRR is probably in the 17% range. And the hurdle's also quality, understanding the underlying assets. We're in an environment, like I said, we're buying off of like 12/31 values. We got to get a pretty big discount given how much the public markets have traded off. We better get a pretty big discount off of what we're buying off of a 12/31 value at this point. And sometimes what happens is there's this pause where sellers need to get educated that we're not going to sell at that large of a discount. But then what will happen is they'll see the hits run through their numbers at March 31, at June 30, and September 30, and then we become more aligned where valuations are coming out.
You mentioned we're not very tech heavy, right? I mean, we're not super allocated toward tech, at least the funds that we're exposed to. Where are the allocations on kind of an industry level?
Yeah, so if we look again, I apologize. I'm trying to balance my phone with my computer here. Let me see if I can go in elements. Yeah, we don't really have we don't have the specific breakdown here, but when I was saying tech, there is tech exposure in LMMI 4, but I guess I meant more early stage venture where there's a tremendous amount of volatility. So so you see here in tech, the IT portion is about 22%. So it's a fair amount. But these are very mature type companies. I was talking more along the lines of some of the venture type back companies where there's a tremendous amount of volatility in that market. That's where it's really, we're going to see it come through in our valuations.
Just out of curiosity, and maybe I'm missing it, what's the investment in the energy sector?
You know what? That's tiny. We do very little energy, but it's actually related to. There's a group in LMMI 4 here, Metalmark. They didn't make the top 10, but Metalmark. Sometimes we're buying a portfolio of funds, and there might be a fund manager that actually has a little bit of an energy company in their thing, but it's a fraction of what we do.
Okay, just because of a historical expertise, or are you actively deciding to avoid energy?
Yeah, well, I would say we have actively, and our middle market fund's a little different where there's not a lot of energy specific funds, but we don't have a lot of expertise in energy. We have a principal down in our New York office that has educated himself on energy. He'll look at the energy deals, but we have purposely stayed away from energy to a large extent. You might see a little bit more energy in our global secondary strategy, but in our middle market strategy, it's tiny. But even in our global strategy, it's going to be less than 5%.
Okay.
Mark, this is Brian. Can you tell me what the markdown overall in the portfolio is, given what's happening in the public markets?
Yeah, I think what you're going to see in LMMI 3 and LMMI 4 when you get your first quarter statements is you'll see valuations that are relatively flat to up single-digit percentages. So I don't think you're going to see a markdown in our fund when you get your first quarter report. And that's based off of, I think about 50, 60% of underlying GPs reporting their values to us.
Hello? Oh, it smells like clean laundry.
I'm on the, thank you, Mark.
Yep. And again, just to highlight that last question, Bruce, you know, in our funds, particularly this middle market strategy, it's very little public exposure.
Are there other questions?
I've got a quick question. I wouldn't think that there would be any public exposure. There is?
Well, yeah, what would happen is, again, we're usually buying into a fund and it's usually heavily private, but they may exit that company by taking it public and not selling it. They're not, unable to sell their public holdings. They usually under lockup for 6 to 9 months, and then they will trickle it out over time. And that again, in the middle market, it's more private sales or sales to strategic companies, but there are folks that do take their companies public. Again, most of the time it happens after we buy into their funds. But yes, we do. There are situations where we're buying into these private equity funds that happen to have some public holdings.
Okay, thanks.
And again, just you know, when we underwrite deals where there's a public in it, we usually attribute no value creation or no increase in the share price from the time we buy it to the time we think they're going to exit. So we're pretty harsh on underwriting public companies.
You are.
Mark, it's Brian. I had a quick question. You made the comment before about other public funds being over allocated. Is that a function of overcommitting? Is it a function of just the denominator going down with the public markets, or a combination of both?
Yeah, it's more the denominator effect right now, Brian. But in the private equity world now, the GPs are all coming back faster than people expected. So they used to raise money every 3 to 4 years. Now they're raising money every 2 years, and a lot of these large public folks are not increasing their allocation to private equity. Some of them are trying to, but some of them haven't, and so they're really struggling on re-upping to some sponsors and other GPs they really like, and so they may sell some of their older stuff as part of that process to try to continue to commit to private equity. They're not exiting private equity. They're just trying to manage to an allocation that's been set to them from their board.
Right. Yeah, thanks for that perspective.
Because I can't see if anyone else has a question or raising their hand. So please, if you'd like to ask a question of Mark, please do. All right, I guess with that said, thank you very much for coming in and spending the time with us. I'm happy to hear you think that this upcoming March 30 valuation report's going to be okay.
And I think even through June we're going to be okay.
All
So
right. Beautiful. Well, thank you again for spending
Yeah.
time with us. I really do appreciate your giving us a quick overview. Thank you.
Yep. Thanks for having me.
Bye-bye.
Thank you, Mark.
Thanks, Brian.
All right, guys. Thanks for that. Next up will be Brian Binkley. I'm going to share my screen, right? You're not allowed to share your screen. Can
I
you
can give it a shot if you want me to try, Carolyn.
want to give it a shot? Go for it.
All right, let me give it a shot here. Let me close Lexington's.
Oh,
Go to the
terrific.
front. Is it on?
Yep, yep, it's up and running.
Okay.
Thank you.
Okay, good. Yeah, you're right. Like when I have it up, it's hard to see if there's a hand or a question. So jump in. I miss seeing you all in person as we did the last couple of months, but hopefully this will work just as well as we had practice during the COVID time. So you know, if I look back, I always try to find a theme for kind of each meeting, and you know, this year's continued to drift down since the March meeting, or from April's meeting with March returns. But I was looking back, and you know, there's a slide I have in the deck later. It's, you know, there's never an average year. Like even last year, returns were so strong, it wasn't average. You know, I looked back at our 1 year return as of April, and the pension plan was up 26%. The OPEB was up 34%, and those were great numbers, but far from average on the upside. And then here in 2022, we're seeing the downside in both equity and fixed income. But you know, I think we you know, we keep that long-term commitment, you know, long-term perspective, and I have some slides on that, and the plan will be just fine. So I'm here on page 4, and I usually recap the markets, both equity and fixed income, share some perspective on that, and that very much mirrors what we have in the pension plan as far as our public assets. As you heard from Mark, the private assets are still up marked as of 12/31, but doing well. So let's start here on page 4. I'll just focus on the year-to-date numbers. But we have U.S. equities now at the end of April that were down 14%. We finally got some diversification benefit, you know, through the non-U.S. stocks. I would call it only, but still down a lot, you know, down 11%. But that's why we do hold a diversified portfolio of both U.S. stocks and non-U.S. stocks. Same with on the bond portfolio. So U.S. bonds down 9.6% as yields were still rising in the month of April. They've come back a little bit in May. And we hold some non-U.S. bonds for diversification because, you know, the different central banks of different policies. So non-U.S. bonds down just 7%. I speak just briefly on the sectors because, not surprisingly, if you were to look at the sectors, we talked a little bit about energy before in last meeting, but it's all the defensive sectors that are kind of doing well now, whether it's year to date or 1 year. When I think of defensives, well, energy doesn't always have to be defensive, but given what's happening with inflation, it's certainly doing well. But consumer staples, utility stocks, that move or that rotation has certainly taken place as people are looking more for safety, and sectors like information technology, IT tech, and consumer discretionary stocks, you know, are really the ones that have fallen by a large degree. Then with respect to the fixed income markets, you know, when we last moved, we hadn't seen much by way of spread widening in the markets, and you're starting to see that now as markets start to think about possible recession. You know, not many people are forecasting yet for 2022, but you see investment grade credit now on a year-to-date basis down more like, say, 4% to government bonds, and that's because spreads have widened, and same happening a little bit in the high yield market. So something to keep an eye on. And with respect to that discussion is, I expect our capital market forecast to be updated as of March in the next week or so. So that'll be a topic that we've talked about in the past, and I'll bring forward to the next meeting to see how adding some credit, what that could do to the risk return profile of the pension plan and OPEB plan. Yield curve here on page 7. You know, still very flat from where we were, but again in May we saw like the 10-year yields come back down to like 2.8%. You know, they were as high as 3.2, but the yield curve is still flat, and I think most are expecting it to remain so, as the Fed will continue to raise rates on the short term to stave off inflation. So the next few slides I put in here just some longer term perspective, and you know, bear markets, you know, which we hit in, you know, in several markets now. Bear market really defined as a decline of 20% or more. And you'll see here that, you know, bear markets, you know, can and do happen every so often. You know, we've seen that, it seems like we've gotten more of our fair share in the last 12 years, like since 2008, including the one here in 2022. It's five different bear markets just since 2008. But as we often preach, we have a long-term investment objective for these plans, and to stay disciplined with that asset allocation. And here just kind of shows over the longer term, well, whether it was the last slide or this slide, bear markets, you know, you do see big drawdowns, but they tend to be shorter. Bear markets have you know, on average lasted 236 days, you know, less than a year, whereas a bull market tends to be longer. You see an average length of 852 days and stronger as far as the return on the upside. So just some perspective on the long term with respect to the equity markets. Lastly, on, you know, page 10, you know, a lot of the best trading days happen right next to the worst trading days. So trying to time the markets, whether on a short term or longer term basis, can be futile, but so just a good perspective of keeping fully invested. And this was the slide I was referring to on page 11. This goes back, you know, since 1926. You could see, you know, average stock returns 10% over that long period of time, almost century. Average bond return over that period has been 5%. So clearly an equity risk premium of investing in equities over bonds. But you have very few years. Let's call it in the last century, you only had 2 years where you had average stock and average bond returns. So we know it's going to be bumpy, you know, we know it's going to be volatile, and markets are hard to predict. But I thought that was an interesting graphic that I wanted to share with the committee. Skip over page 12.
Looks like Brian's having a little technical difficulties. Let's see if he can't come back to us. Brian's going to dial back in. So as Brian gets himself kind of dialed back in, we can take a couple minute pause, everyone. We'll give him a little time. Okay, well, Brian just texted me that he's having some trouble getting reconnected. So we'll give him a few more minutes. Why don't we kind of put the review on pause there for a moment? Tonight's just one of those kind of nights, guys. Item number 5 in our agenda, the old business. This is where Jared, our town CFO, would come in. He was called away right before the meeting started and is not able to join us. So we don't have those reviews tonight. We'll catch up with them next month. And that leaves us with new business. Right. And so on the new business front, I don't have anything new. I wonder if anyone has anything they kind of want to bring forward. The one thing I would like to kind of put out there is in July, our July meeting will be our discount rate meeting. And so we'll arrange to have the actuary come back in, give us a presentation. This will be kind of Milliman's first time, really with with the full benefit of their having our data. So that's what I have coming up ahead. There's any other new business or thoughts, you know, happy to talk about it.
Nope, I don't have anything.
Nothing for me.
Okay. Okay.
For me, either, Carolyn.
Pardon me?
Nothing for me as well.
Okay. I'll give you a little color from the Board of Finance presentation we did last week. And some feedback. They were really happy with Milliman. They also we share them we share the actuary in certain aspects, and they were delighted. They kind of came back and said, thank you for doing the RFP. Thank you for making that change, and felt it was a real big uptick for us from a quality standpoint. So I thought I was really delighted to hear them say that, and we put in a lot of time and effort. So thank you all for pushing that boulder up the hill. Other than that, the only other thought they had was just market volatility, right? And of course, looking for that line of communication, should we make any change regarding our July meeting and the discount rate. But it went super smoothly, and I think they were happy to see that we are discharging our duties professionally and correctly here.
Carolyn, what did they like about Milliman? Did they, anything specific?
Yeah, their comment was just the amount of context. So if you recall previously, it was we just saw data, you just saw the numbers. What Milliman is part of the reason that Milliman was selected was they're educators as well as data providers. And so putting some color around the data allowed them to feel that, kind of understand at a deeper level.
Good.
Carolyn, could I ask, this is Tom, I'm just curious, will Milliman be talking about what peer municipalities are using as a discount rate as well?
They will. They
Great.
will. Yeah. Locally
Love to hear
and
the state.
nationally.
Perfect.
Hmm?
State level, municipal, all that kind of thing, right?
Yep.
Great.
Yep. That was one of the reasons why they were selected, was they really seemed to bring a lot of comparables to the table to enable everyone to make a much more fulsome decision.
Great.
What day is that July meeting?
July 27th. So fourth Wednesday of the month.
Okay.
Right? Well, I don't have anything else. And it seems that Brian is having some technical issues. So we have the presentation. Right? We can look at the numbers. I'm happy that he went through that front part about kind of some thoughts on the markets. Happy to hang on a little bit longer and give him a little bit more time to struggle to connect. If you guys want to give him a little.
I'm Carolyn, if I may, I'm wondering if he just had sort of a Wi-Fi breakdown and this could be, an extended thing.
Yeah, what he just texted me was, you should proceed. I'll join back as soon as I can. Right? And I haven't seen anything. So
That might be next month.
exactly. Guys, I don't know how you feel, but I mean, I'm pretty satisfied. We have the data, we have the numbers, we have the reports. We got through the kind of the softer points he brings forward. I'm
going to make a adjourn.
I'm very happy to. Yep. So you've made a motion to adjourn. May we have a second to adjourn?
I'll second, Jack.
Second.
All right. Thank you. Thanks, Kevin. Thanks, Eric. Everyone, thank you very much. 7:49, guys. We are adjourned. See you later.
Thanks.
Have a good night.
Good night.
Night.